Welcome to the Sound of Economics. My name is Guntram Wolff, and in today's Directors podcast, I bring to you a conversation with Valdis Dombrovskis, Vice-President of the European Commission and responsible for the important file Capital Markets Union, which is today discussed at the informal Ecofin here in Sofia. And together with my colleagues André, Sapir and Nicolas Véron, we have prepared a paper on Capital Markets Union, what's next, how to make it a reality. It's a long-standing project. There has been discussions about deepening and enlarging capital markets in the European Union for many, many years, at least going back to Lamfalussy, Larosière, also both very important reports, but it's a flagship priority of this European Commission. The Commission has put forward more than 13, I think around 13 legislative proposals, but many have not yet been adopted, and the discussion is actually very controversial in the Ecofin. Mr. Vice President, perhaps you can give our listeners a first overview why you think this Capital Markets Union project is so important for Europe, for the European Union, perhaps also for Europe's monetary union, and what should be the priorities at this stage?
Well, as regards Capital Markets Union, indeed it's one of our flagship projects, and we believe that by 2019 we should have main building elements of the Capital Markets Union in place. So the main idea of Capital Markets Union is to put European savings to productive use, to put those savings to investments. And it's also to diversify financing sources of EU economy. EU economy is traditionally very reliant on bank financing, and capital markets are less developed. To give an example, EU's economy is comparable in size with US, but our capital markets in equity are only half as big as US, and in debt they are only 1/3 as big. So there is lots of potential actually to increase capital markets' role in financing European economy. Then on what has been achieved so far, indeed, out of the 13 legislative proposals which have been put out so far, only 3 are adopted. We talk here about improved rules for European venture capital, EUVECA label. We talk about simplified rules in our prospectus regulation, which makes it easier and cheaper for companies to raise money in public markets, to raise money through listing, and by setting up a framework of a simple, transparent and standardized securitization. Now, if you look at further work, I would outline 3 priorities. So the first priority is to give scale to Europe's capital markets to use the full scale of EU single market. And for this we come with proposals which are enabling pan-European financial products or provision of certain services across the EU. To give some examples, we have put forward a proposal of pan-European personal pensions product, or what we call PEP, which would be accessible to all Europeans and would allow them to have an option for their pensions savings across the EU. And also having it portable if Europeans are moving from one country to another. We have proposed EU-wide licensing framework for crowdfunding. So crowdfunding markets are growing very quickly. In the last 3 years, every year they have grown more than 100%. but they are still largely confined to national markets. So we proposed to enable crowdfunding based on single EU license. Another priority is to simplify and streamline our regulatory requirements for businesses. There I would remind our call for evidence, where we looked at the cumulative effects of post-crisis regulation, and we are now looking how to make rules simpler, how to achieve the same prudential results in a more growth-friendly way, and we are following it in different pieces of legislation. Here I will also mention, for example, our proposal on restructuring of viable business debt in a way that which would allow companies a second chance, so simplifying those requirements. We soon, for example, will come with proposals to simplify conditions for small and medium enterprises listings in SME growth markets. And the third priority is more consistent supervision of capital markets. That's why we put forward review of European supervisory authorities to equip European supervisory authorities with necessary power, but also with necessary financing to ensure more consistent supervision and to ensure supervisory convergence, because it's clear that functioning capital markets needs also streamlined supervision across the EU.
Mm-hmm. Well, thank you very much for this overview and for sort of giving us first the logic, then what has been put up on the plate, and where we are in the current discussions on in terms of priorities. I certainly very much share the point on the motivation, so deeper capital markets in the economic literature, diversified capital markets in the economic literature clearly are helpful for economic resilience, financial resilience, and are helpful in funding our economies. Diversifying different sources of funding is a way of having less financial crisis, being less risk prone, and having probably even better growth performances. So I think it's a very welcome initiative. Now, my main concern, I guess, is that this is not a new topic. I mean, we've been discussing about the single market for capital for a long time. It goes back to Lamfalussy and even earlier the single market process. And if you look at the data, you will see that since the financial crisis, actually there has been a lot of retraction, and capital markets have become more national than they were before the crisis, and there has been only a little bit of a recovery more recently. How sure are you that what is being discussed would really be transformative and would really change the nature of Europe's financial system that currently is still very much bank-based and very national? To what extent can we really shift towards some more diversified funding and more cross-border capital markets activities?
Well, first of all, indeed, discussions on European capital markets are not new, but I would say this crisis and post-crisis experience put a renewed focus on it, because what we saw that bank financing can be quite pro-cyclical. There were easy financing conditions fueling economic growth during the boom years, in a number of cases actually fueling overheating of the economy, asset bubbles, real estate bubbles. And when the crisis came, bank financing suddenly disappeared, thus making economic problems even more severe. Clearly there is an issue, and that's why we emphasize the role of diversify the financing sources of the economy, and a bigger role also for capital markets. And I would say what's maybe also different from previous discussions, that now we have a clear strategy. We have Capital Markets Union as our flagship project. We are putting forward a number of legislative proposals, also other non-legislative action, and we are following through this strategy. And our main message right now is that yes, we are making progress, but more needs to be done, and that's why it's important that now also co-legislators, Council, European Parliament work very actively on this. When we discuss this issue with political leaders, with heads of state and government, there is clear support for Capital Markets Union. Nobody objects in principle. So now it's time to materialize this political support in concrete action and concrete legislation, and that's what we are working on.
One of the important projects in Capital Markets Union is, as you mentioned, also the review of the European supervisory authorities in order to get more supervisory convergence, but perhaps even direct supervisory competences on wholesale finance, on third country CCPs, and perhaps even at some stage on retail. Now, in my discussion in the run-up to the Ecofin with national policymakers, I got often the feedback that supervisory cultures are very different, and one is quite reluctant to share supervisory competences with, or to even give supervisory competences to a European institution because of the fear that standards may be lower, may be different, or supervisory discussions will look differently from what they are now, with possibly negative implications for financial stability. Now, I personally don't share that view, and we have put forward in our paper a very strong case for strengthening the ESMA, so the authority responsible for the supervision of capital markets directly, and think that this should be a centerpiece of a reformed architecture, and that in itself will actually lead to more capital markets integration. How would you reply to the critiques from some member states that perhaps this will lead to a lowering of supervisory standards, or even some financial stability risk compared to what we have now, which is a system of basically national supervisors?
Well, indeed, this is probably one area in our Capital Markets Union work which is more controversial, because when we discuss those proposals as regards scaling up within the EU, as regards simplification and proportionality, everyone is in favor in principle. Then, of course, there are many details which need to be dealt with. Here, indeed, some member states are questioning this principle of putting direct supervisory powers to supervisory authorities, and especially in this case, ESMA. And the situation is less controversial as regards supervisory powers with third countries, but more indeed intra-EU. So there discussions are ongoing. In any case, we are also making this argument that more consistent supervision, either through direct supervisory powers in some, I would say, targeted areas, or through more tools for supervisory authorities to ensure supervisory convergence as implemented then by national competent authorities. They are very important for Capital Markets Union to ensure level playing field, to ensure standards of supervision, and there, I would say, to the contrary to the argument which you mentioned, we believe that this can actually improve standards of supervision. and to avoid practices like forum shopping, for example, where market participants are trying, so to say, shop across the EU, looking supervisors which may be more forthcoming for their specific business models or activities.
Well, but perhaps my last question concerns the departure of the United Kingdom from the European Union. The City of London currently is the financial center of Europe and of the European Union. It's one of the global financial centers. And with the departure from the European Union, there is at least a question mark what kind of financial activities can still operate out of London, and what kind of financial activities will have to migrate to the European Union in order to continue to be operated here in the European Union. So to what extent is Brexit a motivation to accelerate CMU, the Capital Markets Union project, and what are the main arguments for really doing it more quickly and more forcefully now?
Indeed, already shortly after the Brexit referendum, European Commission put forward a communication where it was made very clear that following the Brexit referendum and following the fact that the EU's biggest capital market is about to leave the EU, but also single market, it makes the case for CMU even more important and even more urgent. So in a sense, we stepped up the level of ambition of Capital Markets Union following this referendum, because in this case, indeed, the task of developing capital markets across EU 27 becomes more important. On the first part of your question, so what activities it will be possible to provide from London also post-Brexit? Well, I would say this is something which still will be negotiated, probably as part of our discussions of future relations. At EU 27 level, we are currently exploring how we could rely on the system of equivalence decisions, which EU is actually already widely using, more than any other major jurisdiction globally. And we believe this could work also in a case of UK. So this is one area which we are currently working on.
Thank you very much, Mr. Vice President, for this interview.
Thank you.